Hi everyone, welcome to our webinar covering lessons from busy season. Before we dive into today's topic, I'm going to run you through some items to help you best leverage our platform. Your webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different options on the screen. Simply use the corners of the icon to adjust your size or position. You have many tools running across the top ribbon of your dashboard. If you can't find something, look there first. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them in the question box at the lower left corner of your dashboard or push the Ask Question button on your top ribbon. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, you can use the emojis at the bottom of your screen. Seth loves to see the emojis come through, so please use those. Your feedback is valuable to us and it is used to craft future webinars. For those of you seeking CPE credit, you will need to answer 3 out of 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks. Lastly, this session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slide deck, you can download it from the right side of your screen at any time. You will also find links to other resources there. For those of you who aren't familiar with Richie May, we have specialized in serving the mortgage industry for over 40 years. We have a full suite of services and products designed to enable our clients' growth. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching. Today, our presenters include 2 of our mortgage industry experts. I'll turn it over to Jennifer to kick off our introductions.
Hello, I'm going to start with Seth Sprague. I feel like most of you on the call probably know Seth already. Seth is a CMB Director of Mortgage Banking Consulting at Richie May. He's been with us for a number of years now, and he is well sought out by multiple people in the industry. I'm Jennifer Hannah. I am the mortgage banking service line leader. I run the audit practice for mortgage banking at Richie May, and I've been here, 16, 17 years, and in public accounting for 26 years, which is crazy. All right, so what I want to start with is 12/31/2025 audits and how our clients did compared to just each other and overall in the industry. So what we found for our 12/31/2025 audits is most of our clients were profitable. Don't get too excited. They were profitable to the point of a little bit of income over break even. You know, we had some clients that knocked it out of the park. We still had some clients that had losses that were larger producers, and there was still a struggle point of if you had $500 million of production or less, it was still a challenge last year to break even. When we look at net income and profitability, we also like to kind of back out one-time transactions like MSR sales, if you had a release of loan loss reserve to income. If you had some other non-recurring transaction, we like to kind of strip that out of that net income calculation to see would our clients still have made money from originations alone, not just a nice pickup from an MSR sale. And we had a number of clients, at least break even last year, which was nice to see. And we had some make a decent amount of money as well. One thing we did note, like obviously a theme of if you're on low com for MSRs versus fair value, we definitely saw much higher MSR sales when clients were on low com that some of our clients lucked out, and that really helped them meet net income requirements last year. So getting a little bit more granular with our client base and just going through it, we definitely saw an uptick on Ginnie Mae delinquencies, and I'm going to bring Seth in a minute. With our larger lenders, we saw just a decline in cash, an uptick, not only in Ginnie Mae delinquencies, but like mortgage loans held for investment. We saw a lot of our larger lenders decide to retain servicing again. And then that like middle range, not retaining as much servicing. We still had some clients, especially in that $1.5 to $3 billion range, sell servicing to free up some extra cash. And then the larger clients, the theory or the feedback I got from them was it makes their branches and loan officers happy retaining that servicing. It's additional revenue that comes in, obviously, but also just wanting to protect that client base. But with that and the uptick of Ginnie Mae delinquencies, we definitely saw an increase in that line item that says operating lines of credit. That is primarily like MSR advances. And I just wanted to check with Seth to see, is that kind of consistent with what you've seen on your side of the MSR world?
Absolutely. Delinquencies sadly increased at year end. They increased in Q1. They're still increasing in Q2. A lot of that has to do with sort of the April 2022 to today production where that borrower is more stressed. So absolutely delinquencies, particularly in the Ginnie Mae, particularly in the FHA space, is a common theme. There's also been a change in the loss mitigation waterfall for FHA, which caused longer times in delinquencies while people are in their trial payment period. We hope that will get cleaned up a little bit this year as people either are successful in their trial period or they're not. But you're actually going to see foreclosures probably start to tick up. So what's really odd kind of at mid-year is that like short-term Ginnie Mae delinquencies, 30 days are down, but they're significantly up in the 90 and 120 in foreclosure buckets. So you're seeing actually foreclosure activity start. So again, I think when you audit in 2026, you're going to see even a different sort of trend there. But yeah, delinquencies is a real theme. Servicing advances is a real theme. And to be honest with you, some of the servicing advances is just a spike in taxes and insurance on current loans. And I think that's an area where we've seen some people miss sort of forecasting their cash needs, particularly at year end, is that they're advancing on current loans because the borrowers are short due to the massive increase in taxes and insurance. So I think that's another theme that rippled through 2025 that we'll probably see in 2026 as well.
Thank you. Just overall high level, kind of a normal balance sheet. You'll see again, just the larger lenders that are paying attention to like the cash versus current accrued expenses and accounts payable, operating line of credit. We've definitely seen a lot of clients more leveraged than in previous years at least at the higher levels. I think with the mid-sized clients, I think selling some of the servicing has freed up a decent amount of cash for them to, you'll see the difference between the cash and cash equivalents and their current liabilities are quite different from some of the larger lenders. I like this slide because it gives you kind of an idea of what changed from the prior year. So like I mentioned earlier, any client that was $500,000 in production, that net income number went down. This also went down. You'll see like changes. The MSR, you took a hit for your MSRs. There was an increase in loan loss reserve provision and other miscellaneous types of losses. It was still a challenging year last year. And just the MSR adjustments, that's probably going to be a theme throughout this presentation. Seth's going to talk on it, and I'll circle back on it in a little bit later as well. Income statement, you'll see my comment earlier on clients just breaking even, with the exception of the smaller production clients. It was a decent year. I think breaking even, you pay your salary, you pay your bills, you have a little less stress at night, but it's still, not a phenomenal year. But, we did have clients that knocked it out of the park that had really exceptional years as well. So there are exceptions to every rule for sure. And this kind of ties back to the audit. I wanted to go over, start with setting, like this is what happened, but this is kind of how we look at our audit clients. So the minute you send in your trial balance, this is the first thing that we start with. And it is such a basic, simple calculation. We basically look at what operating cash do you have, your escrow cash, does your escrow cash cover your escrow liabilities? And we look at your current liabilities. We look at AP, anything that has to be paid in 12 months. So if you've got an operating line of credit, we'll take that into consideration. If you've got a current portion of a note payable, if you've got lease obligations that you have to pay within the 12 months. And we also consider that loan loss reserve a current obligation, although we know it's not always a current obligation. And we make sure that, okay, your operating cash is sufficient to cover your current expenses. Once we see that, we're like, all right, the client's doing good, we're okay. Now, what if that number is negative? That absolutely doesn't mean that there's a liquidity issue, a going concern issue, or any other concern whatsoever. It just means that we have to go to step 2. We have to look at accounts receivable, the collectability of the accounts receivable. What does your pipeline look like? Is it, a really strong, healthy pipeline at year end? We'll go through your expenses and see, okay, was there like a DOL lawsuit that increased that AP number at year end? But I will tell you this basic calculation, 95% of our clients are perfect on it and we move on. And those that are not, all it means is we look into it a little bit more. It also sets the tone for our risk assessment. So it basically means, if we go through there and there are some liquidity issues with certain clients, we'll have to increase our audit procedures because that risk profile changes a little bit. But I think over the years, a lot of mortgage companies have done a really exceptional job at managing their cash and their treasury. So that feels like, considering how challenging the environment for mortgage has been the prior, couple of years, people are still managing that liquidity number quite well, I think. So let's say there are some type of liquidity issues. Our next step is looking at that Ginnie Mae delinquencies. This really tells us a really great story as an auditor. It's how high is that number? How much did it increase from the prior year? We'll look at that HUD compare ratio to get an idea of, okay, it's kind of close to 200% or it's over 200%. Why are, some of our clients, most of our clients are really aggressive in keeping that number a little bit lower, but sometimes you don't have the cash to buy those loans out of the pool. And so that number will go up. So we'll try and focus on that for like assessing our risk profile as well. And again, we tweak our audit procedures based on what we find with that.
And I'm going to jump in on the Ginnie Mae delinquencies before you go to the poll question, or you go to the poll question, and I'll come back on Ginnie Mae delinquencies. So why don't you ask the poll, and I'll come back on Ginnie Mae's.
You want to do that? Okay. All right. So our first poll question, are you managing cash differently in 26 than you did in 2025?
And so as you're answering that poll question on the Ginnie Mae delinquency side, there's a couple things to consider. And this is where I usually come in and start yelling at people. If your delinquencies in Ginnie Mae are exceptionally high, I go back to what servicing you're actually retaining and what are you doing on the best execution side. Are you keeping the low FICO, high LTVs? Well, your delinquencies are going to be higher. So I go back to if your delinquencies are exceptional, what are you doing on the origination side? And then what are you doing on the servicing retain versus release side? And how is that best execution working out for you? Because look, at the end of the day, if you've retained servicing and you're cash negative, servicing revenue, less expenses, less advances, you're likely retaining the wrong servicing. That's not going to perform very well for you for a cash perspective. And when Jennifer talked about the cash needs, your cash needs are exceptionally going up higher due to those delinquency trends. So I'll stop there chirping about January delinquencies, but you can answer the poll question, but I'll turn it back over to Jennifer.
Thanks, Seth. That was very helpful. We are getting very close on the poll. I'll give it another 10 seconds and then flip over to Seth. All
And remember,
right.
you got to do 3 of the 4 to get credit for your CPEs.
Oh, yes. Thank you. All right. So kind of split a little bit on how you're managing cash. It's interesting. Seth, do you have any thoughts on that?
The follow-up question I'd ask, are you retaining more or less servicing and therefore affecting your cash needs? Like if you sold servicing last year, your cash needs are probably different. If you retain servicing, your cash needs may be different depending on what servicing you retain. So it probably is tied back to more of a servicing and a best execution question as to what they're doing with their cash side of the house.
Yeah. Okay.
All right, so prepayment speeds and impact on repurchase demands. And while this is more of an event that you probably experienced in October of 2025 and Q1 of 2026, if we just go to the next slide and start to look at some prepayment speeds, there's some really interesting things going on here in the space when it comes to sort of prepayment speeds. Ginnie Mae speeds. This is not a news headline that should be tweeted out, but Ginnie Mae speeds are fast. However, as you start to look at what's actually happening, even on the lowest of coupons, those 2% securities, they're starting to experience slightly faster prepayment speeds year over year. I talk about structural turnover all the time, but borrowers that have been in those ultra low mortgage rates for a long period of time are sort of less married to that rate and are starting to see a little bit more turnover activity. People have just been in that house long. They have more kids, fewer kids, more dogs, less dogs, whatever the story is, a different job on the wrong side of town. They need to move. So they're making a decision to move due to a life event. The highest coupon Ginnie Mae's are vapor paper, as I like to say. It did slightly slow from April to May, but again, if you think about what a 6.5% Ginnie Mae 2 security is, that's around a 7% mortgage, and a 6% security is around a 6.5% mortgage. Those are all prepaying faster than 33 CPRs, even in May when they slowed. And if we had the June numbers in here, you'd see they were slightly slower even in June. So prepayment speeds are a concern. And if you're selling servicing released, one of the cash needs or one of the cash sort of hidden needs that you might need to do is sort of refunding of that SRP you got if you sold it servicing release to an aggregator and it prepays in 6 months. So that may be a little bit of a cash shock that you saw in Q1 due to elevated prepayment speeds. Now, I got no idea where rates are going the rest of the year, where prepayment speeds are going, but you are seeing elevated prepayment speeds, particularly in the Ginnie Mae side. And if you're selling servicing released, even though there's a 210-day rule, you may still have some prepayment speed exposure there. On the conventional side, and we just showing the Fannie Mae speeds here, but look at the lowest coupon Fannie Mae's. These are loans that really should never prepay. We talk about the 2%, which is about a 3% mortgage, the 2.5% coupon, which would be a 3.5% mortgage. They're starting to pay around a 6 CPR, which pre-COVID, pre these low note rates, was sort of what we thought was a historical floor to CPRs. And so what we're seeing here again is the higher coupons, when rates go up, slow down, but the lowest coupons continue to increase slightly, and they've increased year over year. What does this mean if you retain servicing? You're actually just going to get less cash flows from those great COVID 3% mortgages that you've been holding on that will last for 30 years because the prepayment speeds are starting to ratchet up on those products. So again, something to be aware of. Prepayment speeds are hypersensitive. They've actually slowed in June again for the higher coupons, but increased again for the lower coupons as a result of sort of elevated turnover. So just be aware of these events, and these micro bubbles of prepayment speeds that occur can really affect your cash with repurchase demands, refunding SRPs, et cetera, on the released execution. With that, I guess I asked this question and then we'll go on to the next topic. But and if anyone from the FASB's on the call, that's a joke. There isn't. Do you think you should include recapture in your MSR value in your evaluation cash flows? And we're going to go through this here in a second in more detail. But just remember, you got to answer 3 of these 4 CPE questions to get your credit. But at the end of the day, if you have been selling servicing released to aggregators kind of through this cycle, you are sort of, in my opinion, benefiting from what I would say is an aggressive MSR valuation that's being paid for the ability to recapture. And as Jennifer had talked about sort of in her opening comments about people retaining servicing, one trend that we're seeing kind of macroly across the industry is that retail-focused mortgage originators are more talking about focused and trying to figure out how much cash can they divert to retain servicing in 2026, because they're sort of afraid that selling into somebody that's got a flywheel is going to sort of, those loans are never going to come back out and they're going to lose that origination and that customer for life. So again, recapture is a huge topic. Many people benefit from where people are potentially including this in sort of the executions out there, but we just wanted to get everyone's flavor. I kind of think I know where this is going to, when we publish the results here, where this is going to go. And I'm probably going to yell at most of you that answer yes. So you can change your answer to no now. But otherwise, you're not getting CPE credit. No, that's just a joke. But at the end of the day, let's see what the results show. So we go, I think we got critical mass. Well, I only have to yell at 36.5% of you then. So for the 36.5% that answered yes, you're not getting any CPE credit. No. This is an interesting conversation, and we'll talk about, Jennifer and I will go back and forth on this shortly. But you know, I think my biggest issue right now, and we'll talk about this in a second, is like, we're not, what are you defining as recapture would change how I would answer this question. So let's dive into this. And Jennifer, let's go back and forth a little bit, because this was a hot topic at the MBA Accounting and Finance Conference last year in Phoenix. And it's certainly going to be a hot topic at the Accounting and Finance Conference in November in Charlotte, if I remember where it is. But I'll give you the synopsis, and then Jennifer can give you how she's going to audit this. Now, at the end of the day, mortgage servicing rights, Penny Mac went to the EITF, kind of raised their hands and, hey, look over here. We have inconsistency across the industry as to how people are either including or not including the value of recapture in the MSR cash flows. And EITF, look over here. We want you to come back with something that makes it consistent. And so the EITF went away, did their work, and said, yep, we think recapture should be part of the MSR cash flows, kind of the same unit. And they recommended to the board that they move forward with including recapture. So in the May meeting at the FASB level, they said, yep, we're going to take up this as a topic. We agree with you, EITF. Great work. Thumbs up. We agree with all your recommendations. And so they are now in process of drafting, is it an exposure document, exposure, whatever? They're right now drafting exposure draft to potentially change the accounting around recapture and its inclusion in MSRs. That'll be out in Q4. There'll be a 45-day comment period. And so this is just where kind of they're at the process. But there's a couple concerns here. One, they're not defining recapture. And I pause there for a pregnant pause for a reason. Is recapture pulling forward gain on sale? Is it change of MSR value? Is it both? Is it something else? And so my personal opinion is that, let's just say if I were running MSR valuation models, I'd be abusing the heck out of this assumption to make my numbers work. And I say that sort of bluntly, which gives Jennifer gray hair. But at the end of the day, this is something that, as it's adopted by the FASB and we get the exposure draft, Jennifer and her team are going to have to audit. So therefore, this is where Jennifer comes back on the spot. Jennifer, recapture, good, bad, and different. How are we going to handle this?
I feel like that's a loaded question for an auditor. I'm not supposed to have too strong of an opinion on this. For us, what's challenging is half the accounting firms say yes, half the accounting firms say no. 36% of my clients want to include it, 24% don't, and then the rest are like, I don't know if I care. I just like the idea of them coming up with a clearly defined rule of yes, it's allowed, no, it's not allowed, because that just makes my life a lot easier. There's no gray area. What I will tell you, in my humble opinion, is, when you need net worth or you need that MSR value to be higher, I think that recapture is wonderful. But I also know it is by far much harder to audit MSRs than it is to audit derivatives, than it is to audit loans held for sale. And the why behind that is there are so many variables and factors that go into that valuation that it's just one more thing that adds volatility to your income statement. So it's wonderful when you're having that pickup in value, but then maybe you go to sell it and you're not quite getting that. Maybe the values drop, you go into a bad MSR market, and so that drop potentially could be more because it's another variable in there. And that's where it's challenging as an auditor, because the people that want that value high, in some years, I have just as many clients that want that number to be conservative as I do aggressive. So I think it's a tricky area, but my personal opinion is I just want an answer. If we all include it, I really think it'll lower the MSR values, like it'll normalize if we don't include it. And I think it's also tricky because if a lot of IMBs take a step back and look, how good are you at recapturing your loans? So it may skew that value for you and hurt or help clients. But that's my political opinion.
Yeah, I don't have a political opinion. I just stated simply that I don't like including in amortization expense or capitalization of servicing something that's called recapture, because that's not a native servicing cash flow. And therefore, I think people, if they're aggressive in their recapture or their capitalization rates, will then be amortizing an expense related to an asset they don't actually have, which will cause the servicing P&L to be negative forever. But we'll see how that plays out. I think is the next topic yours, Jennifer? Yes. Back to you. Most common journal entries. If I remember from my accounting days, it's like debits right, credits left, or debits left and credits right.
You're close.
I don't know. It's a long time since I took the CPA exam.
Totally fine. You're close enough. So we're flipping around a little bit, trying to combine some of the servicing stuff with some of the audit stuff. So I'll pull Seth in on a few of these as well. So here are our most common adjusting journal entries that we had. This is our, I can't say top 10 because we didn't have top 10 common adjusting journal entries, but I think there's 8 maybe?
8. If I counted correctly, but everyone knows I'm bad with numbers.
8. This is the top 8 that we had this year. And it changes yearly, but this tends to be a little bit more consistent. So we'll go through each one in detail. Loan loss reserve is something that has been a hot topic since I started a million years ago. We are actually writing a really detailed white paper on this. It's long. It has a bunch of examples in there and real world specific scenarios that we're going to send out to our client base. And, we're happy to share it with others as well, just so we have a little bit of clarity on loan loss reserve. So what's tricky about this when we audit it is, depending, kind of similar to MSRs, we see it overstated, we see it understated, and we see it perfect on 85% of our clients. So what happens with the loan loss reserve is some clients, it's understated. And most of the time when we see it being understated, it's oftentimes correlated to an owner maybe not understanding why you're writing a provision for losses monthly through his P&L when there's not actually a loss, or it could potentially be, I'm having a really rough year. I'm close on my covenants. I'm close on my HUD net worth. I'm trying to like lower my loan loss reserve a little bit to meet a net income covenant. Another thing that we see is when that number is really large, when people have a $10 million loan loss reserve for the prior 5 years, and they've never had more than $1 million of losses. So it goes both directions. And what's just as tricky with that conservative loan loss reserve is if you're releasing that to income in challenging years, that puts us in a challenging situation of trying to think through, is it managing earnings or is it legitimate? And a lot of the times it's legitimate. You've sold off a big chunk of your portfolio. You don't have as many losses. The rules on repurchases have changed. So you just don't have that obligation, and it's a valid release to income. So you do see both, but it is one of those areas that it's a gray area. It's tricky. It requires judgment. It's not always black and white. So everybody look forward to that white paper that we're going to release. So this one, it's kind of correlated, MSRs, gain on sale or loss of MSRs, and then CECL related to servicing advances. What we're finding is we don't have too many clients that are booking that MSR asset incorrectly. When we bring on new clients, a lot of the times we just know we're going to look at how they book MSRs. There's potentially going to be an adjustment there, but our existing client base does a really good job of booking MSRs, paying attention to what the value should be. We do see every now and then the portfolio. I used my quarterly valuation for a number of years, and then all of a sudden the portfolio is so big that it makes more sense to use the pricing grid. We will make recommendations as the servicing portfolio grows, like, hey, this worked for 5 years, but you really should consider changing your methodology and how you book it. What we see the most with MSRs recently is, and this I think goes back to us having some really tough years the past couple of years, what we've seen is wanting that realized gain number on MSRs to be higher than the change in unrealized gain. So what we'll see when you sell an MSR asset, on the day that you sell it or you lock into the price that you're selling it, you want to look at, what do I have it booked at fair value on my books at? And that should be the difference that you run through the realized gain or loss. But we're seeing that unrealized number, or the number that you have it booked on your balance sheet, people kind of wanting to play with the date a little bit. And that's sometimes to lessen the realized loss, and sometimes it's to increase the unrealized loss. So we just have to be a little mindful of that. And Seth, have you seen that in your world at all, or is that too accounting specific?
It's too accounting specific, but what I will say is that you looped me in a number of times on MSR transactions that are more and more complex, and that target sales price seems to move around. And I'm old and crotchety, so I just want it to be a number, not something that may be a different number 3 months from now or 4 months from now. And I think that increases the level of complexity as you're looking at some of these transactions. I like a clean sale date with a known price, and you deal with the consequences of that number. But there's a lot more fancy MSR transactions out there where that price tends to float for a period of time, and there's a reconciliation back and forth. And I think that really muddies up the waters on your MSR side.
Yeah, we're seeing more and more complexity in MSR sales. And I also have jets flying, so I apologize if you hear jets flying outside of my office. I can't do anything about that. Going back to the recapture, I kind of talked about it earlier, just the volatility it could put to the income statement. That's my only concern. Clients just, what goes up, sometimes it goes down. It's just one more variable, but I'm not opposed to including that in the value. And then we don't see this as much anymore, but we still do see it. And we see it a lot more with like newer clients servicing advances. just, are you paying attention to the due dates? Are you booking them at the amount that we're expected to be collected? Every now and then we still see people with that methodology of, well, the value's booked into the MSR value, so I don't need an allowance on my servicing advance. But when you math it out, there can be some challenges with that methodology, but that would probably be the only thing with the servicing advances. And just one thing to think of, there are a ton of really good companies out there that will go into your servicing advances and kind of pick through that number and sometimes find some cash that you didn't necessarily expect. So don't hesitate to reach out if you'd like some context. How are we on time? Receivables. So this one, primarily we see this, and this is probably one of the first things I look at when we're looking at like a new client, is if you have like first payment receivables that are really aged. A lot of the times clients are like, you know what, we're going to collect them. So I've heard both sides. I've heard a lot of clients say, just because it's on the books over a year, we're still going to collect that first payment receivable from the investor. The loan sold, we're still getting it. And then I've heard probably just as many say, the probability of us collecting that is not super high. So we'll look at that. And just something to think about, an area to potentially focus on, because it also gives us an idea of like how clean everything is. If there's a lot of aged escrows, a lot of aged first payments, we typically see like a consistent pattern with some other things that maybe need some love and attention. If you sold an MSR asset a couple of years ago and you still haven't collected it because you just have to give them a couple more documents, but it's collectible, that's something that can be a little bit challenging as well. We really don't see a lot of branch receivables being booked anymore. If you are booking branch receivables, reach out to me directly and we'll talk through why you're not allowed to do that. Owner receivable versus distribution, another thing to focus on and maybe pay a little bit of attention to. If you've got an owner receivable that the owner is going to book it as a distribution, there is accounting guidance that if you know that you have a receivable that will eventually be distributed, it should be a distribution. You can absolutely book an owner receivable, but just make sure that it's truly a receivable and you just don't have a plan to convert it to a distribution in a year or two.
And on that MSR receivable, truly collectible, I strongly encourage people to negotiate that up front in their MSR contracts, because a lot of buyers will give you a 12-month window to get them all the trailing docs, and then they're just going to keep whatever's left. So in which case that would validate any receivables that you've got out there for some holdbacks. So aggressively managing your buyers and the holdbacks critical to making sure you're getting all the execution that you thought you were getting on that MSR transaction being a sale.
That's helpful. Thank you. Fair value. So we don't typically see a ton of issue with fair value on loans held for sale. Where we do see it is if you have a level 3 loan, something you're booking at scratch and dent. A lot of the times we see that booked at par. It'll be sold and it won't be sold for par. So that can be a little bit tricky. We have some friends in the industry that share some scratch and dent pricing with us. So we've got a pretty good idea of what the value on some of these are. We'll typically sample it and, tap in a friend or see if it's comparable to what we're seeing in the market. So just something to think about. And this says mortgage loans held for investment, but just be mindful. Mortgage loans held for investment is, do you have the intent and ability to hold it to maturity? If it's a scratch and dent loan or a level 3 loan that you're just waiting to sell it, but you're not going to hold that loan until maturity, that should go in your loans held for sale, not mortgage loans held for investment. Derivative assets, pull through. So typically pull through, and again, there's an exception to every rule, but if you're letting your third-party hedge provider calculate and do all of your hedging for you, we typically don't see issues with the pull-through rate. I'm sure there's an exception here or there. It's usually when the secondary department internally is kind of going through and doing additional calculations or changing that hedge coverage, we will find issues with that pull-through rate. And sometimes that can be kind of a larger journal entry than expected. And I think the why behind that is when you think about like a secondary person versus an accountant, like an auditor, how we look at pull-through rate is we look at the IRLCs that are going to pull through. And I think sometimes the secondary department looks at it as a coverage, like how many trades should I take out against this derivative asset? And that little nuance in how we look at it can result in an adjusting journal entry for grossing up that derivative asset balance, which then makes your coverage look a little bit different, which is totally fine. But just something on the accounting department, September, October, test your pull-through rate. If you're hedging internally, if you've got a secondary person that kind of doesn't just go with outside reports, just to make sure that you're set up for success for the year-end audit.
And if you've added new products or new branches, or you're in different locations, i.e. states, you might want to look at your pull-through as well, because it may be different as you've expanded out, where traditionally it was X, but now that you've entered a different market, that market may have different behavior than you're traditionally used to. So again, pull-through is very critical to get as accurate as you can for a variety of reasons.
Thank you. And then these are just our wish list. If you don't do them, it's okay. But it's our wish list. Just time savers for us at year end. If you've got your derivative liability, typically your trades booked with your derivative asset, if you want to reclass that before you send us the trial balance, reclass your restricted cash from operating cash. If you've got construction loans, booking them in a separate loans held for sale account. Going through your hedge report at 12/31 and making sure you're pulling out all those uncommitted loans held for sale before you post your derivative asset number. We still see that one every now and then. Ginnie Mae delinquencies, for some reason, that tends to be one that we end up posting, but clients have the information. The income tax provision, just send us the TB. It's not going to get done before we start the audit, if I had to guess, but that is one that we typically post. And then this is like my dream. This is like if everybody did this, I'd just be like such a happy camper. And most of you on the call, most of our clients do it, but we still have kind of a high number that don't actually look at this. If you're using like a lease software or a lease provider, I think what happens is some people just book the journal entries that come with it, and they don't actually reconcile the right of use asset, the right of use liability, the lease expense to the actual amortization schedules that come with like a Crunchify or a Trulian or some other lease software. And that takes us time to reconcile from the trial balance to the amortization schedule. And that's not, most of our clients do it, but there are a handful that it just takes us time kind of picking it apart so we can get the supporting documents to actually tie to the trial balance. Most of the time it's in terminations or additions of leases, and then extra credit would be rolling it for the cash flow. When you go from your right of use asset, right of use liability, add your additions, subtract your lease terminations, take out your cash paid, take out your amortization expense and that accreted interest. If you can roll your beginning RVU asset and liability to the ending through the cash flow statement, it usually solves all the problems. Like the number of issues and things you find when like prepping the cash flow statement related to MSR sales, related to leases, it's very helpful. I was thinking I'll probably put together a template and maybe we post that on the website or something for people to at least know what I'm talking about. Most of the people on the call understand it. And then last but not least, and this is just a little tip that we keep hearing at conferences, if you have holding companies where your IMB rolls into a holding company and you may have an escrow company, you may have a JV that's separate from one of the IMBs that then rolls into a holding company. Something that we've noticed is we've had agencies and other outside parties request holding company audit engagements. And the why behind that, we think, is to see, okay, is there potentially debt at the holding company that's being paid by the IMB with the licenses? So just be thoughtful of that. We have a feeling they're looking at it together to make sure the net worth requirements are all appropriate at that holding company level. And this is all assumptions, rumor mill stuff, but just we like to, if we hear it, we're going to tell you. Another thing I think that may be a cause for concern, because it's been a couple of challenging years. Let's say, you've got your owner that you're allocating a certain amount of their salary to that holding company. Just be thoughtful that it's reasonable. You have it documented. You have a reasonable methodology for what's going there. I just would hate for someone to come back from the outside and be like, hey, is that salary reasonable? Should that salary have been allocated to the IMB that then messes up your ratios and your net worth requirements at that IMB level? So just something to think about. How are you allocating your expenses? Is it properly documented? And then how much debt do you have at that holding company level? Seth, do you have anything on that?
No, I think you're dead on. I think they're trying to look at a consolidated entity and the cash flows appropriately between the two entities to either fund advances or meet liquidity requirements, capital requirements. So you're dead on.
All right, sir. Next poll question. Have you or do you plan to execute an MSR trade in 2026?
And it's July now, so you got a couple more months if you're going to do one. If you are contemplating an MSR transaction, just remember, probably want to go to market no later than end of October or first week of November to make sure that you can get sale accounting treatment for the year if that is your objective. There's a number of hurdles to reach to get to sale accounting. And so if you decide on December 15th that you need an MSR sale, it's going to be too late for the year. So plan appropriately.
We've had to unravel some of the sales because we haven't received, or the client hasn't received agency approval before year end. So it doesn't meet sale accounting as a 1231. So take what Seth says seriously, because that trips us up every year on at least one client not getting that agency approval before year end.
And remember, after December 15th, it's really hard to track people down for approvals. So that's why we tell people, you kind of want to get that letter of intent signed in early November, latest, I would tell you October, in order to truly be able to comfortable getting a sale in by year end. Because if that's your objective, the last thing you want to do is not have that agency approval and figure out that your favorite agency is not working that day because it's New Year's Eve, and you're not going to get the approval, therefore you're not going to get the sale treatment. And we've seen, sadly, people that had to roll it into the next year, and that creates all sorts of problems. So plan ahead. And as people are going this, if people have got other questions, please put them in the chat. We've got about 10 minutes left, and I'm going to get through next two topics pretty quickly here to make sure the trains run on time. So I think we're pretty much at critical mass here. Remember, you got to answer 3 of the 4 here to get your CPE credits for the year. I'll be interested to see what these results are, because some people may not have servicing to sell at this point, based on what they may have done in the last couple of years and executing some transactions. So few of you, 12.5%. So just plan ahead. The no's, don't have to worry about it. You don't have to do a sale, but those 12.5%. Time to market appropriately, and you're going to want to stick around for the last set of comments about the Federal Reserve if you're trying to execute an MSR sale in the near future. So with that, I'm going to kind of go through this next slide really quickly. Bulk MSR transactions. And this is public data. By no means is this a comprehensive list of all the bulk transactions that are out there. This is simply what hits my email account from about 3 or 4 very active advisors in the space. And it's giving you the totals from this year and the previous years so you can look at it. But the one comment I want to make about 2026 it's a really diverse market when it comes to MSR transactions. The UPB, the average balance and the average loan size are meaningless. We're seeing a lot of deals that are in public space that are above $5 billion in UPB, and we're seeing a lot of deals below 500 million in UPB. And we're not seeing anything around $1 billion or $2 billion. And so it's either people have a lot of servicing, trading a lot of servicing, or people that have a little servicing, trading the little servicing they have. But if we arc back 3 or 4 years, we saw $1 billion, $2 billion, $3 billion deals. We see hardly any of them of that size anymore. They're either under 500 million or they're above 5 billion. And so this is where the average doesn't make any sense. In fact, for the month of June, the two transactions are both above $10 billion that are out in the market. And there's a third one that just came out that's 8 billion. So like there's nothing small this month for that's bidding in July. They're all big deals. So just be aware. And if you've got 500 million of servicing or even 250 million of servicing, there's a market for you where several years ago there wasn't. If we go to the next slide, which is our final poll question, because we're setting up for the final conversation where I'm going to give you some comments about the Federal Reserve in a few minutes. But where do you think 30-year fixed rate mortgage rates will be at the end of 2026? Less than 6, above 7, or somewhere in between, which would be 25 basis point increases. And if you haven't been paying attention to the MBA forecast or other forecasts out there, and not to lead the witness here, but the joke is mortgage rates are going to be around 6.5% for the rest of my career. And so, there's not this huge expectation that rates are coming down. And I'm going to start to arc into, as people answer this question, some of the stuff that the new Fed Chairman Walsh talked about on Capitol Hill over the last couple of days. And it's going to be interesting, and I think it's going to be a challenging period here as Chairman Walsh sort of repivots the Federal Reserve and how they communicate with the investment community. So a couple quick highlights for those that didn't listen to his testimony over the last 2 days. Pretty clear. He's got no tolerance for elevated inflation. In fact, he talks about how it's been elevated above a Fed target for over 63 months, and that's just not acceptable. And remember, got to answer 3 of these 4 questions here to get to your CPE credit. So we'll give this poll another couple seconds. But he doesn't talk about what his new target is. He talks about imperfect measures of inflation exist today. So he's, to me, kind of being very coy in talking about, yes, it's elevated, but I'm not even going to tell you how I'm going to measure in the future. And so let's go to the poll results real quick. And most of you are, 2% of you are, something's really going to go wrong, maybe, to get below 6%. No, he's above 7. I actually got booed off stage in Texas when I said mortgage rates will hit 7% before 5.5%. I got booed. But I would agree. I think 6.25 to 6.75 is pretty much where we're going to be for the rest of the year, which at 6.25, remember, is a little bit of refinance activity. And 6.75, there isn't. There's a bunch of slides here on the Fed, but I've got other slides that are off script here. But as we think about where Chairman Walsh may be taking this, if he changes the measure of inflation, and I was joking with one of the tax partners the other day, and I made myself 7 feet tall because I changed the measurement of a foot from 12 inches to 10.5 inches, and therefore now I'm 7 foot tall and everything's good in the world and it could be drafted by the NBA. So if he's going to change the metrics around inflation and be more fluid in what he's evaluating, this is going to create volatility in the market and uncertainty. And the loop in here is, if you are going to be executing an MSR transaction over the next several months, I strongly encourage you to understand when the Fed is meeting and don't bid that transaction anywhere near a Fed announcement, because we have no idea what this Fed's going to do with rates up or down. Whereas the previous Fed, we had all this telegraphing of what they're doing. So I would expect in your capital markets, and if you're doing MSR transactions, highly volatile potential days around a Fed meeting and potentially Fed action without knowing what they're going to do. The Fed's going to be in this period less obvious as what they're doing. That's going to create volatility. That's going to create some risk for everybody on this call. So just be aware of that as you're looking at capital markets, being short or long, your positions on the pipeline side, and executing an MSR trade. Do not trade MSR transactions around a Fed announcement. It's going to not go well for you, or it'll be great for you, but I can't tell you which way it's going to go. So I would not bid transactions around the Federal Reserve comments anymore, or the Federal Reserve dates. Inflation numbers, the most recent ones came out a little bit more favorable. But again, Chairman Walsh goes, one number isn't dictating where we're going. He knows housing is lagging. He knows there's a huge affordability problem. And we know that the Federal Reserve is going to act differently going forward when it comes to communication, what units of measure they're going to use for inflation, how they're going to look at productivity and jobs, how they're going to look at the true cost of inflation, and how they're going to try to improve some of these metrics. And so they have more real-time data. So at the end of the day, what I would expect during this transition period is more uncertainty, more volatility, and more just, hey, here's a refinance cycle that we didn't think was happening because somebody thought the Fed was going to say this and they didn't do this. And so as you kind of think about like this old Fed dot plot, this is going to go away potentially. I am not a rate forecaster. I can't tell you where rates are going to be by the end of this call in 3 minutes. But at the end of the day, just be aware that volatility is going to go up. And this is going to have to affect how you think about doing business going forward. And I mean, it'll be fun times. We'll survive this. This isn't the end of the world. But it is going to be a more volatile Fed going forward, at least until we understand how they're going to communicate with the markets going forward. And there's vastly different opinions out there. Is this going to be good or bad? I'm not on either one of those camps. It's just going to be different. The market will eventually adjust. But during this adjustment period, just be cautious that Fed announcement days are all of a sudden going to be a little bit more volatile in your mortgage business. We got a couple minutes for questions. I don't know if we've got any questions out there, but this is the kind of the expectation of rates going forward. I have no idea if this is correct. You can find another graph that's a different flavor of ice cream if you want out there. There's all sorts of expectations around the Federal Reserve. One kind of quick question for you, Jennifer. When do interim audit procedures start for you, and what are some of the best practices around interim procedures?
Oh, I like that. So our interim procedures for compliance, we typically get all those lists out August, early September. September, we are on the ground running. We like to get the TB. We like to have planning calls to know, did you have an MSR sale that we can test outside of season? Did you bring on a bunch of new branches? Like anything throughout the year that you can reach out to your audit manager or audit partner and let them know what is happening with your company. It just makes us more successful in the audit because we know what's coming, what's going on. We can look at a lot of this stuff at an interim time and, pull it outside of our audit busy season.
Great. So communicate. With that, we'd like to thank everybody for their time today. There is a survey at the end. We do take the survey responses seriously, so please fill out the survey. But thank you for your time. Have a good rest of your summer, rest of July, and we'll be chatting with you soon. Thank you.
Thank you.